So coming up to the next topic, financial planning. We just winded off with the primary objective of financial management. We winded off with the importance of financial management. Now we are doing financial planning. Now what exactly do we mean by financial planning? It is exactly like planning. What to do, when to do, how to do, why to do. But what, where, when, how, why, everything is related to finances. It's like a blueprint which is prepared in advance. Why? Because we want to know that what are the sources of finance, how these funds, how this source will be made available, how these funds will be utilized. We first estimate the requirement of funds and then we talk about the availability of funds. Financial planning. So why do we need to do financial planning? We'll read that. Financial planning is preparation of financial blueprint. You prepare a blueprint, that means you prepare a kind of map work you do in advance of an organization's future operations. What you're going to operate in future with, that is what you're going to work in, how you're going to manage your finances in future. So next we talk about is objective of financial planning. Here, please get it very clear, objective and twin objectives of financial planning are different. We are going to study about the basic objective, just an explanation that what exactly financial planning wants to highlight at. So first thing is, objective of financial planning is to ensure that enough funds are available at right time. What exactly do we mean by enough funds are available at right time? Suppose I need money right now and I don't have enough of funds for my operations, for my business. What I do is I borrow from outside. When I borrow from outside, I pay interest on it. Rather than that, what I can do is I can use my own money which I had to take from a debtor. So that money should have been there with me, or whatever fund was there with me, I would have not spent that money and kept it for as a buffer for future operations. So money should be available at right time. The funds should be available at right time. Second, if adequate funds are not available, so if they are not available, what happens? What are the problems do we face? The firm will not be able to honor its commitments. Now, if you don't have enough money, if you have to make payments to someone, you will not be able to pay and carry out its plan, and you will not be able to carry out your plan. Suppose you want to pay to the vendor or maybe some supplier you promised long time back, some creditor who had to take money from you. You promised him that you are going to pay money after some time and you are unable to pay. So it affects your goodwill. Anyhow, financial planning talks about future operation. It says that you should keep your money ready intact. If excess funds are available, it will unnecessarily add to the cost and may encourage wasteful expenditure. Now, if you have more funds available, what happens? It will unnecessarily add to the cost and encourage wasteful expenditure. Now, there should not be shortage of funds, and excess of funds just kept idle is a very bad idea. Why it's a bad idea? Suppose you have extra money and you just generally invest in a particular asset. Now when you want money, you try to sell that asset, and that asset is, suppose that's a land or maybe something else, and you're trying to sell that particular asset off and you're not able to sell it off. You need money urgently, excess fund deployed at the wrong place is a problem. So if excess funds are available, it will unnecessarily add to the cost and may encourage wasteful expenditure. And also, if you borrow too much from somewhere, that will add to the cost. If you keep your money idle, that is also not a good idea. So neither the funds and even that excess funds which you have with you, if you don't utilize it, you keep it as idle, or you borrow more, either of the situations, financial planning will be a super flop. So it should be that whatever funds are required, they should be available at the right time, and that estimation should be done in advance so that you do not waste your resources unnecessarily by deploying them at the wrong places and increasing the cost unnecessarily. Twin objective of financial planning. Now, what are the twin objective of financial planning? First is to ensure availability of funds whenever required. This includes a proper estimation of funds. So you need to estimate how much funds are required for different purposes, such as for the purchase of long-term assets or to meet day-to-day expenses. You should be very clear about that you want money for long-term assets, or do you want money for day-to-day expenses. That is, we are talking about fixed capital as well as working capital. Here, time at which these funds are to be made available is also estimated. So you must know the time also, and the availability is accordingly along with the sources. You must know which source are you going in for. If it's your own money, good enough. Retained earnings, always available. If it is equity, you want to, even expensive equity is not a very good idea. When you spend too much of money on procuring equity, like your basic preliminary expenses become too many, so that's not a very good idea. Flotation cost becomes too much, that's again not a very good idea, either in case of debt or equity, whichever way it is. And debt itself is expensive, is a cheaper source of finance, but it becomes expensive when you have to pay the interest. Not that otherwise in calculation debt is a cheaper source of finance, but if you borrow too much and you have to pay too much of interest and you don't have enough of earning, where will you pay the money from? So that way, yes, that doesn't become a very good idea at that time. So if you estimate everything in advance, you can use your retained earnings, you can use your debt, you can use equity, all accordingly. Next, to see that firm does not raise resources unnecessarily. Excess funding is as bad as inadequate funding. So if you have more funds, that's also bad. Why? Because that means you have not put your money into the right use. That means you have not taken up the right venture. Also, along with that, excess funding, maybe you borrowed too much, that's also not a very good idea. So either of the ways, bad idea. Surplus money should be put to best possible use. Yes, don't keep it idle, don't put it in the wrong place. Like I told you, give an example, don't put it in an asset which would not be sold after some time and you incur losses in lieu of that. Losses in the terms that you put money into an asset, and that asset, when you want money, you don't have enough of liquid cash in hand, that asset is not sold off, and even if it is sold off, it's sold off at lesser amount, not a good idea. Financial resources should not be left idle and must not add to the cost, whichever way it is. So they should not neither be costly and nor should they be left idle. These are the two twin objectives of financial planning, almost similar, but then when we talk about the object of financial planning, they say that the funds should be made available, and if they are not available, then what happens, and if their excess funds are available, then what happens. And twin objective comes under these two headings. This was a 4-mark board question once. This was also a board question once, that's why I've given it like this. And there are other definitions of financial planning. These are also identification question. Financial planning involves proper matching of funds. So you're making what? You're matching the funds with what? Funds requirement and their availability. So how funds are, how much funds are required and how they are available. That's one of the definition of financial planning, like I told in the very beginning. Then again, next definition says it's a process of estimating what? Funds requirement. Always we'll talk about requirement of a business, and specifying the sources, like sources of funds is called financial planning. Of course, yes, when you talk about source of fund, which source are you advocating for? Are you going in for debt, equity, or you're going for loan from the bank or financial institution? What is that exactly is your idea? Are you using your own retained earnings? You need to be very clear. Are you using mix of all these things? You need to be very clear about the finances which you are using. So for that clarity, you need to be properly planned. Your finances should be properly planned. Imagine if you have to go for a picnic, what do you tell your mom? Mom, give me money, give me 10,000 rupees. If you go for a one-day picnic, mom will never give you. She'll say, wow, what do you need the money for? I've paid money for your one-day picnic to and fro. Travel has been done. Food I'm giving you from home. Extra money if you need, you just take 1,000 rupees. Why do you need 10,000 rupees? Financial planning. Whenever there's a wedding at home, mom plans out how much you spend on everyone. Financial planning. So when mom does it at home, the same thing dad does it in the office or for the business. It is again financial planning. Your piggy bank is nothing else, your financial planning. So all these things term out to be nothing else but financial planning, estimating the requirement of funds, sources of funds, as well as availability of funds whenever these are required. Next we will do is the importance of financial planning. Talking about financial planning, now we come to importance. The first point in importance of financial planning is forecast. As the name suggests, financial planning. Planning means future or futuristic. Futuristic we're talking about is the forecast only. So financial planning helps in forecasting which may happen in future under different business situations. Like we did not plan for COVID-19. Once lockdown was announced, people planned their finances, and then when the second lockdown was announced, they replanned their finances. So that became a continuous process, but it was happening for the future. This helps the firms to face the eventual situation in a better way. Yeah, we were not well prepared for it, but then eventually we got prepared for the next few months. So since February or March till the present scenario, that is till October, finances were planned out in a better manner. It makes a firm better prepared to face the future, so you are able to face the future in a more effective manner by preparing a blueprint. Like I told you, when you prepare a kind of a rough sketch or a map of the situation, or like a mind map or a flow chart situation, the management may decide what must be done. Of course, they decide in advance what must be done, and then when actually that event happens, they're able to apply that particular thing what they had initially decided. So financial planning helps in taking future operations or working on future operations. Shocks and surprises. Just simply, if we take example of COVID-19, it was a shock and a surprise for every single business. It was a surprise for schools even. The fee structure talked about, the salaries of teachers talked about, the business situations talked about, the essential commodities talked about. If and when we are properly prepared with our finances, it becomes easier to face the real situation. It helps in avoiding business shocks and surprises and helps the companies in preparing for future. You'd say, ma'am, why are you giving example of COVID-19 every time? It may not happen next year. It may not. COVID-19 is just an example. Next year, maybe nothing happens. Things go on very fine and you're able to save that money for reinvestment into the business. But that's also financial planning. So any kind of shocks and surprises when they come, you're ready with your finances, and even if they don't come, you are ready with the forecast for how to make the funds available at right time and where to invest. Coordinating. It helps in coordinating various business functions. For example, when we talk about sales and production functions, by providing clear policies and procedure. If your finances are properly planned, you know how much are you going to be, you just forecast your sales. You make the production happen accordingly. This is here you can take example of festival time, Diwali time. You can take example of Diwali time when, or maybe Christmas time, or whatever the festivals are in different states or different places. Diwali is a national festival. We all celebrate it. The production for things are more in comparison to throughout the year, and the sales also happen more. This year what is going to happen, we may not know because of COVID-19, but yes, Diwali is a big festival for all the people in India. So production and sales both happen more. If we plan our finances properly, we'll be able to coordinate the things in a better manner. Next we talk about is efficient use of resources. Detailed plans of action prepared under financial planning reduces waste, duplication of efforts and gaps in planning. Very simple. Planning, here we're talking in terms of financial planning. How it reduces waste? If you know you do not want to waste money, you do not want to waste your funds, what are you going to do? You're going to supervise everything so that unnecessarily none of the raw material is wasted. Now, reduced waste, duplication. Two people will never perform the same kind of task, of efforts and gaps in planning. Any kind of plan which you prepare in order to actually reduce your cost, will be talking about efficient use of resources. Efficiency means what? Reducing cost of production, increasing sales, increasing profit, and no wastage. First chapter, business studies, first book, nature and significance of management, same thing. Efficient use of resources. So resources are not wasted out here. Imagine just from the point of view of the resource not being wasted, you are being more planned with your finances. Next, it provides link between the present and the future. You plan for the future. Plan for future in what terms? In terms of the finances. So you're linking present with the future. Okay, next point is continuous. Financial planning provides a link between investment and financing decision on a continuous basis. Yes, why? The day you stop your financial planning, your business will sink. Advice from a teacher: never stop putting money in your piggy bank. That's your personal, continuous financial planning. Same, the moment business stops creating provisions and reserves for unforeseen circumstances, it will not be able to survive for a very long time. So it has to be the business has to plan continuously in terms of finances. Now, evaluation. When detailed objectives for various business segment is planned, the evaluation actual performance becomes easier. Yes. See, what exactly do we mean? Once you have your standards set, then actual performance becomes easier. Controlling. Last chapter, 8th chapter. Now relate to it, how it's getting through. If you are planned financially, planned means if your standards are set, actual performance, work done, what was the output can be easily evaluated. So if you have planned yourself for this current year, and in case there are some extra expenditure which are happening next year, you can immediately make a check and avoid those expenditure, or next month you can avoid them, so that you are able to reach the or you are able to get more profits, or you're able to reach the target much easily. So when detailed objectives for various business segment is planned, the evaluation of actual performance becomes easier. Why evaluation? Why checking becomes easier? Because you're well planned for. Now we finish off with the financial planning. Next we are going to take up is capital structure. We are going to talk about trading on equity, factors affecting capital structure, and after that we will be talking about fixed capital and working capital and management of fixed capital. Till then, bye bye.